Good morning, all. It's Sunday, November 13. Happy It's weekend of Veterans Day, holiday weekend. I want to wish you, thank all fellow veterans for your service to our country. I hope you all enjoy your weekend. Anyway, this is time for my weekly update on the S&P 500 and bond market data. And also we'll be talking about the economic data that came out last week of significance. Should be a much shorter presentation than last week. I know last week went over an hour. I'm hoping I can actually make this one down to easily less than half an hour. So we don't really have two reports to cover on the economic data part. That'll be the inflation, or the consumer price index more specifically, the downstream end of inflation, and also the Michigan consumer sentiment data. So, and that's it. At the end of the video, we'll talk about what economic reports are coming out this coming week. That'll be covered for next week, right? So that said, let's get to some of this data right now. I'll try to put some bookmarks in there so you get more straight to the point with certain areas of the video that might interest you. So watch out for those. And all right, so, and also please use your pause button on certain screens if you need more time to parse through some of the information. I'm going to try to get through fairly quickly though, okay? Alright guys, we're going to start with the usual S&P 500 and bond market summary. I guess I would say with the earnings data versus bond market. Alright, so this week the current value went up about 5 points from 49.20 to 49.25. My future targets, though, they all either were unchanged or went down 5 to 15 points. As you see here, it's definitely going to be flattening, maybe a little bit of a decline here between 2 and 3 quarters out, and before it should resume an upward trajectory. 12-month price estimate was unchanged at 51.25, as did my ideal trading range. Again, ideal trading range is only based on earnings. It does not factor in risk of recession or market sentiment or anything like that. If you just looked at the raw earnings data alone, that's what it's currently telling us. It still remains to be seen if it's going to stay that way. We'll see how it goes though. And last week's updates, the effect were plus 2 points versus plus 7 expected. We were up to 444 companies reported now. It's 88.3% of the index. So we're a significant way through the quarter already, and still barely halfway through the quarter. Since the quarter began, we are up about 81 points from where we were at the start. And the percent of the companies reporting positive earnings growth is ticked down a little bit from 58.3% to 57.2%. Looking ahead to the following 4 weeks, you see it really slows down here. 14 companies only reporting this coming week. I'm expecting a -2 effect on my current value target. That's this number right here. So what I'm saying here is it could drop back down to 49.20 next week, possibly. The following week, the week of Thanksgiving, I believe that is 10 companies reporting, expecting a +4 effect. And December, the November 28th to 2 December, 9 companies with no expected effect at all. And rounding out the next 4 weeks, 5 December through 9 December, only 7 companies reporting for +2 effect. And in all, that means that makes 40 companies over the next 4 weeks. Just about 8% of the index reporting, which is very slow. And it will slow us some more until we get into until we start seeing the front half of, actually maybe around the middle of January start to come into the picture. Alright, stock versus bonds. This is where things are kind of interesting, I guess, in a way. So starting off here with the S&P 500 earnings yield, it actually dropped from 2.74% last week to 2.54% this week. Again, we don't really want to see it drop down into the negative. Like to see higher positive, but yeah, this is just what happens when the economy slows. All right, 10-year bond yield, however, it ticked down from 4.17% last week to 3.82. Now, this is something that normally you don't see. I'm going to talk about that in a second here. 10-year bond yield minus the 2-year yield, looking for inversion here. It inverted even more from 49 basis points inverted to 52 basis points. I believe that's the largest amount of inversion that I've seen so far in this bull cycle, or in this cycle. I don't even know if I'd call it a bull run cycle. It's we're in bear market territory, so I'm going to digress on that. All right, average long-term bond yield. These are the ones that can affect the G fund or TSP's G fund growth rate. That actually dropped down pretty quickly from plus 4.3% to plus 3.99%. So there was clearly a move toward bonds at that during last week, at least the long-term bonds. And then the recommended stock bond mix is unchanged at 40% stocks and 60% bonds. All right, so normally, at least for a 401k investor like a TSP participant, you'll normally see money going either out of stocks and into bonds, or from bonds into stocks. The fact that we're seeing buying activity on both the bond and stock market side this week, that's indicative of foreign interest in the bond market. So yeah, because they say if you're a domestic investor, you're probably having to take your money out of one side and shift it into the other. Now, the reason why this is happening is because the inflation data that I'm going to cover here later in this presentation here, that looked looked more favorable than I guess analysts were expecting. And because of that, the inflation is like the dollar value is going to be dropping. I will show you that as well, like I normally do. And when the value of the dollar drops, now you have kind of a double whammy gain, whatever, for foreign investors in U.S. bonds, because they can buy U.S. bonds at a higher yield, and then when they buy into U.S. bonds, it pushes the yield down, but the price goes up for the bonds themselves. And now with the weaker inflation data, that'll drive the value of the dollar index down. And so, when the value of the dollar drops relative to their country's currency, that's a double effect on the. It's kind of it's an arbitrage situation there, basically. All right, so that covered. I'm going to go ahead and continue on with the rest of this footage here. All right, so this week we only had 2 companies with $100+ billion market caps report earnings. Well, technically Berkshire Hathaway reported Saturday of last week, but since they missed the cutoff for being included in last week's update, I am including them in this week's information instead. Berkshire has, I think, a $700 and some odd billion market cap. They're a pretty good sized company, basically. They beat my previous estimate, and their earnings were actually up as well, and their earnings estimate revisions were also higher. So that's good on them. And the other one was Walt Disney Company, DIS. They missed what my expectation was, and the earnings were also down, and also their estimate revisions are lower. All right, looking at the complete list of companies that reported updated earnings last week, or which I did updates for, whether or not they did updates. Here you go. They're ranked by market cap, as you see there. Walt Disney is the only one at the $100+ billion market cap. They're at $173 billion. Got a few of them here who are below the bubble line, I would call it, for remaining in the S&P 500. The minimum to get into the S&P 500, or technically to stay in the S&P, would be $8.2 billion. And you see there we got Norwegian Cruise Lines, Dentsply Sirona, and Ralph Lauren. Those are all below. However, they might only be down below that level because of just broader market sentiment or something. I don't know for sure if I'd say any of them are in real danger of getting removed from the index. I'd have to go through the list to and sort it from smallest to biggest to see where they're even at in relation to the bottom of the list there. Anyway, though, this kind of give you an idea. If you look at this quarter here, right, in this right side peach colored cell, compare it to the black cell, and that's how what they actually reported relative to what they did the same quarter last year. The green cells here are what they're projected to do over the next 4 quarters, and the cumulative amount of these compared to these is what you get here. And I'm going to have these sorted here by for momentum and contrarian by opportunity screens here in a second. Alright, so sorting down this list of companies that reported last week that I would call momentum buys. Here you go. Top of that list would be Constellation Energy, followed by Norwegian Cruise Lines. Both of them are supposed to at least double their earnings over the next year. Constellation Energy, though, I would expect that, because they're oil price dependent, and I'm not sure oil price is going to go a heck of a lot higher, so I would expect them to possibly taper off. And Norwegian Cruise Lines, since they're a leisure stock, and there are concerns about weakening consumer sentiment, and with possible recession, layoffs happening. That's another one where I'd be a little bit concerned about how much conviction there's going to be with their earnings per share growing. SolarEdge Technologies, that's the solar industry, and marijuana stocks always seem to be the two industries that newcomer investors like to focus their attention on the most. However, I want to also keep in mind that solar stocks tend to get more interest when oil prices are high, and when oil or energy, whatever prices drop, they don't have as much interest. So again, there are some risks that can come with that. However, if they do get the earnings per share growth that they're currently expecting, there's a better chance that their price will do the same. Mostly, though, as you see here, got leisure stuff here like Wynn Resorts, and then got tech stocks like Activision Blizzard, TransDigm Group. Walt Disney actually did make it into this list, so that's worth considering if you're looking at a bigger company. Most of these are on a smaller side, though. And looking at the Contrarian buy screen here, these are the ones that have double-digit declines in earnings expected over the next year. Now the idea on these again is dollar cost averaging. So the earnings per share is expected to drop that much over the next year, then it's definitely a case for seeing the price drop as well. However, price drop means that the stocks go on sale. You can buy more shares with the same amount of money. So that's where you can take advantage of opportunities. Like if these are going to turn the corner and go the opposite direction eventually, which there's a good chance that most of them will. It's definitely worth buying into them for dollar cost. Occidental Petroleum, that's one I'd be a little bit concerned about there. Like I said, most of the energy sector stocks are doing well with earnings per share expectations. So why are they in double-digit negative territory here? Something I would definitely want to look into if I had any interest in buying it. Same with and I think energy. I want to say it's utility, but I forget. It might be a energy sector company. I have to just check my records again. Whatever the case might be, though, again, this group of looks like about 10 or 11. I think 10 stocks here would be the ones that worth considering if you're looking for something that's getting beat up and possibly will turn the corner and turn positive in the coming months. And looking ahead to next week's earnings updates, we have this list here, not a very large list, of course. We do have 5 companies with greater than $100 billion market caps reporting, though, and then a 6th one that is not far below 100. So we're going to start with Tuesday. We got Walmart and Home Depot both reporting earnings. And then on Wednesday, we have Nvidia, Cisco, and Lowe's all reporting. You might see here it's all pretty well focused on retail stocks for the most part. Walmart, Home Depot, Target, Advanced Auto Parts, Lowe's, TJX, the parent company of TJ Maxx stores, Copart, Bath and Body Works, and Ross Stars. Those are all very well-known retailers. So a lot of info about retail stocks there, and that could cause the market sentiment to shift as well. Because depending on what they announce in their earnings updates, their conference calls, and all that, could give different clues that could give the short-sighted market sentiment cause to shift directions. All right, looking at the bond yield curve, this is something I wanted to talk about earlier. So you see here the long-term bonds, the yield did drop below 4%. Definitely have clear sign of inversion going on there. Like I mentioned earlier, it's more inverted now than it was earlier, at least between the 2-year and the 10-year, which is the brown one here. Even the short term, like the 2-month and 3-month, are actually up higher than the 5, 7, and 10-year yields, and that's actually a little bit of a concern there. Actually, more than a little concerning. However, we don't have bond yields across the board up in the high 5s, low 6s like we've seen in the past. So that's at least gives some hope that if we do fall into recession, there's not such a strong chance that it would be a long and very steep recession like we saw in 2001 or 2007. It might not be as bad. So there's at least that we can say put some hope on. I do expect the Fed might do some more rate hikes in the near future, though, and that would actually create more upward effect here on the short-term bonds in particular. I mentioned in the past, 30-day yield will give you a lot of clues about what the bond market thinks about Fed rate activity. It tends to move in advance of what the Fed rate actually is, so it's still sitting here at 370-ish. Yeah, so right near the bottom end of where the current Fed funds rate range is. And if they do start getting more conviction that the Fed is going to raise rates again in December, I would expect it to climb up to above 4% here, which again is a bit of a concern here, especially if the long-term bond yields stay down below 4. All right, let's go ahead and move on to the charts now. This is the S&P futures price chart. It's the daily 1 year that we're looking at now. We're still definitely within this price trend here, this downward channel here. However, did get a really nice gain there on Thursday, or yeah, I think it was Thursday. That actually pushed us up above the 100-day moving average. So that's nice. So at this point, I would expect possibly to come back down and test the 100 for possible support before continuing up to the 200-day average, which is currently at 40.82. I would expect to find resistance here at the 200-day average. I think we're going to need more than just one CPI report to get us back in the upward direction long term. But yeah, this is likely the 200-day average is definitely a spot where I would expect to find resistance. So if you're looking at swing trade somewhere in that neighborhood there, 40.75, 40.80 perhaps. Might be where you want to look at selling out for short term, and then plan on buying back in somewhere when it drops back down. Whether 39.12 ends up being a good spot, I don't know. It does look like we might be starting to get higher lows here at the very least, maybe even higher highs. We can also project that out a little bit. Alright, so we got a high right there and coming up this way. So yeah, we're right around where the high would be on this new trend here. Got a lot of buy activity right there, but we'll say we'll start a trend right there. Okay, so we could end up in this range here. Looks like up above 37.50 on the bottom end, and up to right around the 4,000 level where we're at now. I said, but I wouldn't be surprised if it breaks through this trend and it works its way up here to the 200-day average. Again, I would expect to find some resistance at the 200-day. So definitely, yeah, even if it pauses, I would at least expect the price to stop there before going any higher or in any other direction. Looking at the weekly for this same index, let's go ahead and zoom in some on that. As you see here, yeah, we had an engulfing candle there, engulfed the both of the two previous weeks, and at least on the weekly chart, the next point of resistance looks like it's going to be up here by where the 50 and 100-day averages are at, and that is up in the 4170. If you look up here where I'm at now, the 50 days at 4170 and the 100-day is at 4187. So the weekly looks better as far as bullishness is concerned than the daily chart does, but those are definitely two possible points of resistance with the price. Moving ahead to the crude oil price chart. I think last week I had mentioned it had gotten back up to about $95 a barrel. As you see here, it's back down to 88.86. It's right in that, like I mentioned before in previous weeks, it seems to want to hover around the 85 or so dollar per barrel mark. And it seems to be where it found support right there at 85. We do have a bit of a wedge here that does look like it is staying inside this wedge between the 50 and 100-day averages. The top end there, the 100-day average is at 91.11 right now, so we could possibly see it settle down into this 85 to 90 range perhaps. What'll happen after that remains to be seen. Like I say, Russia and Ukraine has a lot to do with what's going on here, and until that issue gets resolved, I would expect this to bias toward the high side than anything. Looking at the weekly for crude oil, again, just looking at moving averages, we are definitely inside a tight range here between the 10 and 50-day moving averages, or 10 to 50-week moving averages, I apologize. And those are also in the same neighborhood there. 86.40 is where the 10-week average currently is at, and 94.64 is where the 50-week average is. So all indications are we're probably going to stay in the 85 to $95 per barrel neighborhood unless something new comes up. I would say, I could mention the previous weeks we've been seeing it wanting to hover around this 85-90 neighborhood. So actually, looking at the weekly, it definitely looks like it's favoring the 90 neighborhood a lot. We got 5 consecutive weeks right there where it was in the 90-ish neighborhood, at least at some point during the week. And we got 2 more weeks in a row here, and almost one right there as well, where it was right around 90. So yeah, I would say around 90-ish per barrel is where it definitely wants to favor at the moment. Looking at the dollar index now, it's the daily chart. This is quite a precipitous drop there, as you see there. Broke right through some of the support levels there. Like it see there, it's 1, 2, 3, 4. All right, so it got down pretty quickly. Actually, last Friday, Friday of last week on the 4th. Got down to the 10 and 50-day moving averages, but clearly broke down below it, and also broke right past the 100-day average. So that's actually a good sign there, because I've been talking about how the dollar index has been a headwind for corporate earnings lately, and that also contributes to inflation growth, stronger inflation growth for foreign consumers of U.S. goods and services. So seeing this thing come down some actually is nice in a way. So don't want to see it get too far down, but it's good to see this. It'll actually spur more demand for U.S. exports. This has it's also the consumer price index. The weaker than expected report definitely had a lot to do with that as well. Or well, I wouldn't even really say that, because it was already on its way down. It had already broken down below these technical levels here by the time the report came out. This Thursday is when I want to say Thursday was when the report came out. Wednesday or Thursday, whatever. I think it was Thursday though. And you see there, it was already down below, and it just dropped even more. It helped definitely get it down below the 100. So right now, we look like our next, at least moving average base level of support would be at the 104.61 neighborhood. That's where it could stop. There are other technical indicators that plenty of other the technical analysis will actually pay attention to, which I am familiar with a lot of them, and I know how to use them, but I don't cover here. I'm more interested in the fundamentals. Moving averages can have a big impact though, and you can at least get some really good ideas on where reversal points could be just based on moving averages alone. Looking at the 3-week, ooh, that is a nice big breakdown. That is a huge break right there. Got way down here. Actually, we can see a pivot point right here at the 105-ish neighborhood, or 106 area. A pivot point, I mean, is where the price got down to. We saw previous pivot activity in this area here. So we got up, pivoted down at 107, and then pivoted back up in the 105, high 105. Maybe actually right around 105, and then have more pivot activity here around the 104, like 104, 105 neighborhood. So definitely some potential for the price to, the dollar index value to halt or pause, whatever, in this neighborhood somewhere. If not, actually come all the way down here to the 50-week average at 103. So these are, like I said, these are definitely going to be good for U.S. exports, because it'll decrease the inflation pressure on foreign consumers. And again, the S&P 500 is mostly made up of multinational companies, so it definitely has a big impact on the S&P 500 stocks especially. Alright, and looking at the 10-year Treasury note yield here, it's you see here at 38.13. That's actually 10 times what the actual yield is generally at. It's so the actual yield would be about 3.81%. Quite a drop there, and quite a drop means that there was some buying activity on bonds. Look like it's finding it might be hitting some support right here at the 38.13 level where it's at now, or in that neighborhood, whatever. 38.1 is where the moving average is at least the simple. So we could possibly see it pause there. I don't know. I'd really expect it to come down to the 100-day average. I would say there's at least a better possibility it might sit here and pause around somewhere around the 50-day where it's at now. So possibly see some sideways price movement with bonds over the next week. That's what I'm going to predict. Moving on to the weekly. Alright, we finally settled down from this very steep incline there, and we have some possible support right there at that same level again. 38.36 is where the moving average is, the 50-day, the 10-day average. It's not a very strong one to find support at though, so there's a possibility it could continue downward. But there's always there's at least some chance that there'd be some, you might call it buying activity, but it's actually selling activity in bonds at this level. If the yield goes back up, that means bond investors are selling, not buying. It's the opposite. And I will show you. Let's step back. Let's show you how this compares to the S&P 500 studies. Add study, compare with SPX. Okay, so as you see here, it's not unusual for stocks and bonds to move in the same direction like you see right here. Both of them had general uptrends going on there. Both of them had downtrends going on over here. But typically what you would normally see would be them moving in opposite directions. So like right here, I don't know if I'd say that, but we see a general decline in bond yields right here, which means they're buying bonds, but the S&P price also went up. Right here, actually, we can see a sell-off on the S&P 500 here while bond yields continued upward. This is what you're more apt to see on normal conditions. So just want to demonstrate that it's not unusual at all to see bond prices, or bond yields, and or actually bond prices and stock prices move in the same direction. But it's normally the opposite. So normally bonds will sell off and the bond yields will rise when stock prices are rising, which is actually what I think I might have got myself backward in here. Bond yields going up. See, this is what happens when I'm going by yields instead of prices. The yields going up, prices going up as well. That's normally what what you would see. This would be a more unusual one where the price is going down but yields continue up. We can get more evidence of that by looking at, let's look at HEG. That is the Barclay's Aggregate Bond Index Fund. That is the exact ETF that the TSPF fund invests in too. Alright, so you see here, bond prices, this is generally bond prices. So we did see general increase in both bond and stock prices in this neighborhood here. Look like the prices on both went down, and stock prices preceded the bond drop, and then they both went back up. But when you get generally over here, we started a downtrend in bond prices while stocks continued upward. That is what I say again, is more common, more typical. So it's like I said, it's not unheard of for them to move for bond prices to move in the same direction as stock prices, but it's not as common, nearly as common as seeing them move in the opposite direction. All right, that covers most of the usual stuff that I cover on the week. Now let's go on to the economic data. Again, I'll just be covering the Consumer Price Index and the Michigan Consumer Sentiment Report. All right, looking at the weekly jobless claims. This is initial claims. They did tick back up a little bit more this week to 225 after spending the previous 2 weeks at 218 and bottoming at 214 on 16 October. Actually, you got down to 190 at the end of September. Last week's number was revised upward a little bit from 217 to 218. It's a very small change, not much movement at all going on here. I'd like to see it revised downward more than upward, but very minor adjustments there. Looking at continuing claims, they are also trending in the wrong direction. Not quite to these March levels. Definitely above the July and August numbers that we were seeing before. I mentioned July and August for the initial claims, but those didn't seem to carry over so much into the continuing claims numbers as they seem to be doing now. So again, that's a little bit of a concern there. And last week's number revised upward from 1485 to 1487. And we're up to 1493 now. Looking at the Consumer Price Index, you guys might have heard that it came in below expectations at 7.7%. It actually came in above my expectation. I was expecting 7.5 to 7.6, and I'll explain why here between this slide and the next one. As you see here, between October of 2021 on up to June of this year, you see a more steep rise from month to month, and then it tapered off. It was mostly flat. Actually, it was even trending downward for a couple months, and then went back up in September, and it's kind of accelerating again. So that does kind of support the Fed thesis of raising rates, interest rates a little bit more, the Fed funds rate a little bit more, but I don't know that it's really absolutely necessary. What's driving that? yeah, that's other thing to consider. But yeah, I will show you where if this general trend stays where it's at, we should be fine with inflation on its own. So what goes on here is this is a 12-month figure. So what right now we're doing is comparing 298.12 to or 012 to this 277.948. When the November CPI report comes out, this 277.948 is going to roll off the back end here, and the new standard that we're going to compare against will be 278.802, which is a higher number. As we progress, eventually it'll get to where June of 2022 will be on the far left end here, and by then hopefully this trend stays in the neighborhood it's already in. And when that happens, we're going to see overall consumer price index rate, or the inflation rate at the consumer end, will actually be right inside that 2 to 3 neighborhood that we're looking for. I will show you on the next slide how I'm deriving that information. All right, this is the same data you just saw on the previous chart, translated into a spreadsheet and a table, whatever. So as you see here, we got 7.75% year-over-year growth between prices in October of 2022 and October 2021. Now, looking at those that same trend where I had 4 or 5 months in a row where the month-over-month change was more shallow than the previous 8 months or so. The shallowest of that trend was 42 cents. Or 0.425 points per month, and the steepest was 0.921. So if I average that out to 0.673 points per month and project this down over the next year, this is what we come up with. So we end up with these actual CPI numbers, and from each month to the next, this is where I would project the inflation rate to be, the overall inflation rate to be for consumers as each month progresses at that same average rate. So you can see here, and it's going to get us down easily into below 3% range, possibly if it stays in that neighborhood. So that's an argument possibly for pausing on Fed rate hikes for the time being. However, looking at core inflation, that's another can of worms, and this is what the Fed is mostly concerned with right now, because overall inflation is more volatile in nature, and when core inflation is still rising at a pretty steady rate like that, that is a concern. What's driving that, and what will it take to get it down? Can this be brought down without more Fed rate hikes? I don't know. I'm not expert enough on that area to really say for sure, but I can tell you what the numbers project this at over the next year if it continues at this pace. What we have here is core inflation, same information translated into a table and spreadsheet. You see here, actually it was up about 8.27% on the inflation rate, a core inflation rate. But as it, and same numbers here, I got $1.27 or so, 1.27 points. If we project upward 1.27 points every month for the next year, this is in what we get for core inflation rate from month to month. That'll drop to about 5%, but that's not going to be enough, I believe. I know they really want to see core inflation come down more than that as well. So again, that's going to be an argument for Fed raising their rates a little bit more than they already are. I have concerns about that myself, but the core inflation rate data doesn't lie here. It's kind of does support at least some argument for raising the FFR some more than they already have. Looking ahead to Michigan consumer sentiment data here, came in at 54.7, which is below the last 3 months, but above the June and July numbers. I did mention how we had initial jobless claims spike upward in July, and thankfully it didn't translate into the continuing jobless claims as much as I thought they would. This doesn't look good. However, from a contrarian perspective, it actually could be could be very good, and I will show you that in a second here. This is the same chart projected out 25 or so years. I think about 25 years from back in before 2000. Should be around 1997-ish, around here. So we know that we had a recession in 2001 and another one in 2007. What do we see here? We had the consumer sentiment way up around 107, 110, somewhere in that ballpark, prior to the dot-com crash. And then sentiment crashed as well with it, went down to below 80 here. Around this time is when the market recovered, but stock prices did generally go sideways through here, if I were to show that. And then right here, 2007, we were hitting new highs as well, but both for stock prices and for consumer sentiment before the housing market crash. And Great Recession came and caused both consumer sentiment and stock prices to plummet. Got down below 60 on the consumer sentiment data here in 2008, 2009. Right at the beginning of 2009 is when the market and the economy recovered. And you see there, it was mostly a steady rise. It did drop down here around 2011 or 12. I don't recall we didn't have a recession at that point in time, but sentiment did drop. So that is an argument for why you don't make investment decisions based on one single indicator ever. Consumer sentiment going down like that does tend to bode poorly for stock prices and earnings and all that, because it becomes a self-fulfilling prophecy. Basically, consumers are spending less of their money even though they have the money, because they're concerned about losing their jobs or not having as much discretionary income to spend, so they quit spending, and that creates a snowball effect on the economy, because now businesses that need their business to continue their growth, which includes employment growth, they tend to reverse course and start laying off workers and reporting lower earnings, and everything just looking bad. But anyway, you see sentiment ended up getting back up to above 100 at the start of 2020. Dropped very quickly when the pandemic hit and recovered back to about 85, 90-ish. I would say above 85, but below 90, before dropping back off. And it's we're down below the Great Recession numbers here with the consumer sentiment. So that's why I say this is actually a contrarian indication that we might see a recovery at this level. I won't say that with a lot of conviction. I still think there's definitely a chance for more pain in the coming months before we see some gains. But like I mentioned, if we do see a recession, I don't think it's going to be as bad as we saw in 2001 or 2007. And like I said, this could be an indication that we could possibly be turning the corner and heading back north as well. Taking a quick look at the insider selling versus buying. We're still kind of in the middle range. It's actually starting to lean maybe a little bit back toward the buy side, which is a positive. And look at that truckload freight rates. We're looking for signs of economic recovery here as well. Spot load posts are where I'm especially interested in with this data, because you see here over the last 12 months, spot load posts are actually down more than 50%, which is a lot, and that's wreaked havoc on freight rates for truckers to make money off of. On a monthly basis, from September to October, it's still down 10% as well. So seeing a positive number here for the week is actually refreshing, because that's another sign that a question about whether or not we're going to see a reversal in the economic activity. Maybe we might start seeing it head back to the north again. Whether that's going to be the case or this is just seasonality because of the holidays coming up, that remains to be seen. So we'll see how it goes. But spot truck posts are also up more than spot loads. However, on a raw number-to-number basis, that doesn't really tell much. We got to know exactly how many loads are being posted and how many trucks are being posted and what they change by in raw numbers to know if there really are, if there's really a proportionate number of trucks to loads being increased, or if there really are more trucks being available than the amount of loads being increased as well. Looking at the rates here, see how they appear to have like at least flattened out. Actually gone up a penny per mile between last week and this week on van and flatbed, and actually up 4 cents per mile on the reefer side. That's refrigerated side, by the way, if you guys aren't really sure. That's actually a promising sign there. At least, I mean, even if it could be short-lived, it at least gives some hope that there's a possibility we could be finding a bottoming process here. I think it's still a little bit early there. Let's see how the rest of November shakes out. But again, there's at least a short-term lull there is what it's suggesting. Average fuel prices, it looks pretty stable there, 532, 534-ish. But now we're comparing a couple of monthly results to weekly results here. It did drop down to, I think, if I recall, 512 a couple of weeks ago, or 2 or 3 weeks ago, and has since gone back up to the same neighborhood. Again, it looks to be trying to find stability in that area. Corresponds with crude oil prices seeming to want to stay around the $85 to $90 per barrel range. All right, to end this week's update, we have this coming week's economic reports of higher impact scheduled. Tuesday the 15th, we got the producer price index, or producer inflation month over month, or really just the PPI report. Wednesday we have retail sales report coming out in the morning, and Thursday we got housing starts and building permits, and Friday we got existing home sales. So most of this focus is going to be on the housing market on the back part of the week. Producer price index, definitely one that'll be of some interest to us as well. You look here and see what the consensus estimates are, and or actually that's what the previous compared to what the consensus was, and then the forecast is what they're expecting on this next upcoming. Now, month over month, they're forecasting 0.3%. I've talked before that 0.2 to 0.4 range is actually right what I would call the sweet spot to get us in the neighborhood we want to be in with inflation growth. Retail sales are expected to be strong month over month, and whether that's just seasonal or that's something we'll cover there later on, because we are getting into November or October. It's starting to get into holiday shopping season, so I would expect it to be more seasonally strong right now. We have to look at the trend though. Housing starts look like it's forecast to drop from 1.439 to 1.4, and same with building permits. They're supposed to slow down as our existing home sales. No surprise there. Alright, well, that's going to be a wrap for this week's weekly update on the S&P 500 bond market and economic data. Thank you for taking the time to watch this if you made it all the way through this. It's probably a little bit longer than I wanted it to be, but again, there are a lot of details here I want to make sure get covered, and I will hopefully have the bookmarks for you there, so you can skip ahead to whatever you might be more interested in. Okay, so all right, well, thanks again for watching, and we'll see you next week. All right, thanks.